It's a pleasure to be here. Thank the organizers for inviting me and giving me this opportunity to speak to you. So I get to talk about money, which is a great subject. And in particular, my goal is going to be to put different forms of money that you've no doubt heard about, cash and of course cryptocurrencies, in perspective in the overall money landscape. And I thought I'd start off with a quote from a recent speech by Augustin Carstens. Augustin Carstens is the general manager of the Bank for International Settlements, and he gave a speech in which he did refer to Bitcoin as a bubble, a Ponzi scheme, and an environmental disaster, and that was the headline. But a more important takeaway from the speech, I think, is this idea. He talks about trust and the importance of trust in underpinning the value of currency. And it's interesting, but central banks were founded after a breakdown in trust. So a guy named Johann Palmstruck was one of the first people to issue paper notes backing gold or other metals that he held at the Stockholm's Banco back in the early 1600s. And he got a little bit carried away, was a little bit too exuberant in the issuing of these notes and issued more than he had currency, and ultimately this led to a failure, and this was the impetus for the beginning of the Riksbank, which was the first central bank back in 1668. So trust is important, and the question then becomes, though, are central banks the best supporters of this trust? And there's certainly recent examples where central banks may have gone a little awry, and this Venezuela might be an example. But there's also plenty of stories of success. So we've certainly had great success with currencies holding their value, certainly in the United States would be an example. And one of the reasons why government currencies are successful is because they have a little bit of help, because they have laws. So one of the things that's true of paper money, for example, in the United States is that it's legal tender for all debts, public and private. And that's a pretty important thing. I mean, what that means is that while we don't just have to hope someone else will take our currency if we accept it from someone, we know someone will. We know the government, for example, will accept it when we pay our taxes. And also this legal tender for private debts is important too. It's important to understand what that means. It doesn't mean that people have to take cash. A person who's selling hot dogs at a hot dog stand doesn't have to accept cash for the hot dogs unless they give you the hot dog and let you eat it. Once that's occurred, they've allowed you to incur a debt, and then they do have to take cash to let you pay for that debt. Okay, so the point is that there's this government backing, in some sense, to the currency. Not backing like gold in the old gold standard, but there's this legal enforcement that helps it have value. And so the question is that the best way to do it? It's one way to do it. As I said, it's been successful sometimes, it's not been successful others. Is it the best way? I won't answer that question. But there's certainly another way, and that's with protocols. Right, so what we see in Bitcoin is we see a new type of monetary policy, a fixed money supply. Everyone here probably understands how that works. New coins are issued at a decreasing rate over time, but the point is that it's fixed, it's predetermined. All right, so that's another way to try to get trust, because you tie your hands. Okay, you can't engage in a type monetary policy that might debase the value of the currency because it's fixed. It's fixed in the protocol. And so the question arises, is that necessarily better, right? Well, I won't necessarily answer that, but that's something to entertain. And it's also worth pointing out that this isn't a new idea. So economists for many years have talked about a debate which is called rules versus discretion. That is, what is the best form of policy? So a guy named Stanley Fischer, who's the former vice chairman of the Federal Reserve, wrote a very famous paper on this that went through history and talked about the different ideas of whether or not we should have discretion. I mean, after all, the Federal Reserve banking system was founded. It's in the title of the Federal Reserve Act of 1913. It was founded on the idea of elastic currency supply. But with the ability to vary the currency comes possible risks. And so should we have a fixed rule versus discretion? So in some sense, Bitcoin rekindles that old debate because it brings back the notion of fixed rules. Anyway, as I said, that does bring me to Bitcoin. I always like to highlight the very first line of the white paper, which basically says a peer-to-peer version of electronic cash. Because I just focused on the idea of the fixed protocol because trust is such an important idea underlying the value of a currency. But there are many attributes to Bitcoin that are also worth discussing. Okay? One is that it's peer-to-peer. Okay? It's basically a substitute for cash, an electronic substitute for cash. And also it allows certain types of anonymity. Okay, they call it pseudo-anonymous. I mean, you have to have a public address, but you don't have to necessarily link your private identity to that public address. And of course, it's autonomous from the central government. These are key properties that I'm going to use to talk about it and identify it. But before I get to that, I want to talk about some predecessors. DigiCash is just a fascinating one by David Chum. This paper from the University of California, Santa Barbara, my home university, interestingly enough. And what was DigiCash? DigiCash addressed a very interesting problem. This wasn't about separating yourself from banks. In fact, this is a system that worked through private banks. It was actually implemented by Mercantile Bank of the United States and Deutsche Bank in Germany. But the idea was to try and preserve a particular type of anonymity, what's called third-party anonymity. So the idea is that the person who provides your payment services shouldn't know what you're doing. They shouldn't know that you're here in Puerto Rico. They have no reason to know this if you were to pay with, say, your credit card. And so the idea here was to have a system whereby cash gets pooled at the bank. Cryptography is used to provide an anonymous ownership to that cash, and then that cash can be moved by the bank without knowing who it's actually moving it for. So a very interesting predecessor. The next one, I want to just make an interesting point. I did this survey. I teach a very large undergraduate economics class because the question is, do people really want privacy, right? This is kind of an interesting question. I don't know if people are familiar with Venmo, but Venmo is very popular in California. It's a way to make payments. And you make payments by signing up through, or one way to make payments is by signing up through Facebook. 80% of the students in a class of 800 used Venmo, over 800. And 44% of them allowed their transactions to be public. That is, anyone can see the transactions they're making. And an additional 21 allowed their Facebook friends. So roughly 63% are letting their transactions basically be public. So it raises kind of an interesting question about how important privacy is in payments to a lot of people, especially the current generation. The next thing I wanted to hit on was just this idea of autonomy, what I mentioned before, another attribute of Bitcoin. E-gold was a very popular, or not very popular, but very innovative scheme in the late 90s that was introduced by a guy named, an oncologist named Douglas Jackson. And this was a way whereby people deposited cash, which was backed by gold, and then the value in gold could be moved via cell phones to make payments. But these payments were in terms of gold. So this was a system that was essentially autonomous from the government, from the central banking system. This was successful, had many, many users. Ultimately, it ran into trouble with some know your customer regulations, AML regulations that came about after they were founded in response to the Patriot Act. But again, this was an interesting example of autonomy. So we've got these ideas of anonymity, autonomy, and all this eventually comes together in terms of Bitcoin. When I was at the Federal Reserve, I had to explain Bitcoin to a lot of people. I don't want to refer to them as pointy-haired bosses. That's not the message. But this comic is really, I think, intriguing because of the way it starts to explain Bitcoin. It all has to do with zeros and ones. Okay, so now let me try and put some of this in perspective. And I'm going to do this using an old technology from 1981, which is called a Venn diagram. So Venn diagrams are ways to look at the logical relationships between sets or different characteristics. And I'm going to focus on 4 characteristics. And in order to do that, one moves into a diagram that looks a little bit like a flower. So this is a picture that appeared in a recent document that I published with people at the BIS when I was there last year. And we're going to focus on 4 characteristics of money. Universally accessible, electronic, central bank issued, and peer-to-peer. This won't capture all the nuances. It's a finite set. It's a small set of characteristics. But I'll show you how we can use this to get perspective on the general money landscape. Universally accessible basically means that you don't need a membership in order to participate. Okay, electronic is obvious, central bank issued is obvious, and peer-to-peer means basically what it says, that there isn't a central process or a central authority that's organizing the transactions, or in particular, there's no one to complain to if something goes wrong. So the first example would be something like a commodity money or U.S. colonial bills of credit. This fits in the category of things that are universally accessible, peer-to-peer. You just trade by handing it to someone, but if not central bank issued, not electronic. Give you another example from the Bank of Amsterdam. Okay, back in 1609, the Bank of Amsterdam used to take in gold, take in hard metal currencies, because in circulation they would be degraded. People would chip pieces off. And what they would do is they'd write down values in a book entry system and then allow people to trade via a book entry system. So this was called bank money. So it was the first example or early example of central bank issued money that was not electronic, not peer-to-peer. These are the old banknotes that were issued in 1934, gold certificates they were called, by the Federal Reserve. $100,000 bills, nice to have one, but you wouldn't get one because these were only used by Federal Reserve banks to make payments to each other. So this was an example of a central bank issued money that was peer-to-peer. It was transferred by handing the thing over, but was not accessible to the general public. And then we get regular cash. So cash falls in the money flower down. It's universally accessible, central bank issued, peer-to-peer, but not electronic. And we can combine that with commercial bank money. So one thing that's really interesting to remember is that, when we deposit our money into the central bank, into a commercial bank, they're not holding the money for us. We're loaning them that money. We're transforming what is a government or a central bank liability into a commercial bank liability. And we just hope that that bank pays us back. Now, granted, there's FDIC, there's deposit insurance, so we can feel pretty confident about that up to certain values. But it's interesting to understand what's happened when you deposit your money in a bank, because this becomes relevant in thinking about new forms of central bank cryptocurrencies that I'll get to in a moment. Okay. And then, of course, we have electronic transfers of money from bank to bank. In the current system, this would be something like the U.S. FedWire system. This is electronic central bank issued money, but it's not universally acceptable. Again, these are only available to central banks. Now we're getting closer to the type of currencies that we're interested in here, cryptocurrencies. So one predecessor, one could say, of cryptocurrencies are peer-to-peer paper currencies that are issued in localities. Berkshire's is one example in Massachusetts. I put here Ithaca hours. So these are currencies that are issued by communities and used as money in circulation. These are separate from the central banking system, so in a way they are interesting predecessors of things like Bitcoin. This is a Pokey coin. I have virtually no idea what this is. I'm sure people here know better than I do. But it fits into the example of an electronic coin. See, this doesn't fall under universally accessible because you have to be a member of the game platform in order to use it. But these are transacted through some central processor. They're not peer-to-peer, certainly not central bank issued. And now we're moving into a territory that I've done a fair bit of work on, and I think hopefully you think is quite interesting. It's sort of operating in parallel to the space of ICOs, which is the central bank's interest in things like this. There's this question out there, which is, should central banks be issuing a cryptocurrency? And before we get to that question, there's sort of a more fundamental question, which is, should the general public have accounts with the Federal Reserve? And this isn't a new idea. In fact, it was floated by a guy named James Tobin back in the 80s when he presented a notion, what he called deposited currency accounts. And the idea of basically what he said, and this goes back to the idea of what I was emphasizing a few moments ago, which is that when you have paper cash and you deposit it in the bank, you're transferring a central bank liability into a commercial bank liability. And Tobin's basic point was, well, why should you have to do that? If you had large amounts of cash and you wanted to save that or hold on to that for whatever reason, why should you have to put it in a bank? Why should you have to engage in the commercial banking system? I don't think there's anything wrong with that. But the question is, why should you have to? Why shouldn't you have the ability to save large amounts of money central bank issued money in digital form. And this is the idea behind what Tobin called a deposited currency account. These have come into practice in Ecuador. They had something called dinero electronico. Ecuador was dollarized in 2000, so maybe it's not a perfect example because this was US dollar accounts. But this was a system whereby individuals were allowed to have dollar accounts. They could transfer money using their cell phone in Ecuador. That program has recently been discontinued, but it was a good example of a deposited currency account. Then, of course, we get Bitcoin. See where Bitcoin falls in the money flower. So it's universally accessible. It's electronic. And it's peer-to-peer, right? This is the key. This is really the key innovation, right? Is to be able to do peer-to-peer transactions in electronic form, okay, without having a central processor see what you're doing or being in charge or, as I mentioned before, controlling the money supply. This is the key innovation of Bitcoin. So you can see where it falls into the money flower. And as I mentioned, moving parallel with these developments on, in some sense, the private side, we have central bank interest in cryptocurrencies. And there's really two things that have been going on in that space. One is thinking about wholesale versions of cryptocurrencies. So this is the idea of launching a cryptocurrency by the central bank, but that's not universally acceptable. Something that would only be used by banks to make payments. So in some sense, you wouldn't see it. It wouldn't be consumer facing. I mentioned a minute ago, there's something called FedWire, okay, the way that we make large value payments in the United States, or one of the predominant ways of making large value payments. This is how banks pay each other. Okay, you buy a house from me, your bank has to send the money to my bank. That would occur over something called FedWire. That's an electronic system run through a central processor. So the question is, could that be better done through some type of decentralized blockchain type technology? And that's something that I worked on in a project with the Bank of Canada and Payments Canada, where we introduced this notion that was called CAD coin briefly. And the idea of CAD coin was that this would be a central bank issued cryptocurrency. You could think of it as essentially a third part of the monetary base. Instead of just cash and reserves, you'd have cash, reserves, and CAD coin, all right? And the idea would be that this system could operate either instead of or in parallel with the existing large value payment system, and we could move money around much like Bitcoin's moved around, with one big difference, which is that when you move to these applications in financial market infrastructures, especially applications involving the central bank, you don't need proof of work because you can have trust. And so their trust in the system can be performed, again, by the central bank, but you're trying to take advantage or leverage the other decentralized aspects of peer-to-peer style transactions on a blockchain. So that's a very interesting project. And then, of course, on the retail side, in the United States at least, there was a proposal called FedCoin. FedCoin almost sounded antithetical to the idea of Bitcoin in the sense that there's government involvement, but the idea there was to get functionality over philosophy, right? So the idea was to take all the best things about Bitcoin, but eliminate the volatility problem by tying it to the US dollar. This was never a Fed proposal, by the way. It was the proposal by someone called J.P. Koning, but it generated a lot of discussion. And then lastly, just as an example that we used in our paper, was this idea of thinking about private sector versions of wholesale digital currencies. So that is the idea of setting up a system whereby individual banks would transmit payments to each other using cryptocurrencies in a closed system. Okay? And then that brings us to the current interest in ICOs. So there are many, many different interests in launching ICOs. This is where they would fit in on the money flower. Okay, so they're certainly electronic, may or may not be universally acceptable, right? One can think of people who are thinking about launching coins for the purposes of creating high liquid assets, maybe tied to fiat currencies even, but not issued by the central bank. One can think about the many ideas there are out there for creating closed marketplaces. These might be examples of things that would fit into the idea of peer-to-peer electronic but not universal. so many concepts have been floated around for that. And I wanted to sort of finish up by talking a little bit about what the motives are for some of these new developments. One of the things that we pointed out in our study with the BIS is that one of the countries that's most active in thinking about cryptocurrencies from the side of the central bank is Sweden. And one of the reasons this is happening is because cash in circulation is falling so fast in Sweden. Low and getting lower. So now below 2% by value of transactions. Okay, lower than what it is here. And if cash is disappearing, this raises a lot of interesting questions. Going back to what I've been sort of keying in on so far. If there's no cash, should the government provide an alternative? That is, should they provide a digital form of money? And the Riksbank recently published a working paper where they throw out some ideas for how to do this. One would be something similar to deposited currency accounts. One would be to use cryptography, something analogous to Bitcoin as we've been discussing, only maybe with the value tied to the dollar, so more like a FedCoin style proposal. And another value is to use something like stored value card technology. Remember, with a stored value card, when you transfer value, it doesn't communicate with a bank. No one sees the transaction being made, so it preserves this sort of anonymity feature, particularly third-party anonymity from the payment service provider that cash has. And so the real question is, if cash disappears, should the central banks be providing a digital cash substitute? And I emphasize this idea, cash substitute. Again, something that has anonymity properties, which is kind of interesting because here we're talking about the central bank providing anonymity from itself. That may seem like a strange concept, but that's what they do with cash. Okay, although albeit that wasn't a conscious decision, that just sort of evolved over time. But thinking about that property, interesting concepts. Okay, one that cannot be done in isolation because Bitcoin and other cryptocurrencies are out there as well, so the central bank has to think about what it wants to do in the general scheme of the overall money landscape. But certainly in places like Sweden, where cash is disappearing, this issue has come to the forefront, and there's a lot of interesting, active, and I would say open-minded discussions in terms of how to handle it. I mean, one of the key things they do here is they go out for public comment. They ask the people what they want, because ultimately that's what central banks try to do, right? Central banks have core objectives, and they have to meet these core objectives. One of those objectives is provision of payment services. But they also have other objectives, financial stability objectives, monetary policy objectives. But they try to meet all these objectives in concert with best serving the needs of their public. One other thing I wanted to just highlight off of this is that one of the impetuses for the decline in cash in Sweden is the success of a payment system called Swish. Swish is a payment system in operation that allows people to transfer commercial bank money instantly, transaction cost free on their cell phones. Very, very successful. When you have a very well-functioning peer-to-peer payment system, cash starts to disappear. Again, peer-to-peer, that's the key. All right. But I should add, a recent study just published by the BIS points out that cash isn't disappearing everywhere. In fact, cash is on the rise in many countries. All right. If you look at this chart, it shows you various CPMI countries, advanced economies, emerging market countries. Maybe if you just look at the panel on the right, you see the 45-degree line. Any cases where the dots are above the 40-degree line means that cash is improving, or cash use is increasing. Not by a lot. Just to put this into simple numbers, an increase from 2000 to 2016 from 7% to 9% of GDP value. All right. But the main reason cash has gone up here, by the way, is as a store of value. The most of the increase comes in the forms of large denomination bills, which is a result of the fact that the opportunity cost of holding cash is so low recently because interest rates have been so low. Not necessarily something that will continue once interest rates go back up again. Okay. So I'm going to finish off with just a couple of quick quotes. So one is from Mark Carney. This was a recent speech he gave in March where he talks about cryptocurrencies and what the Bank of England's current stance is. He says, being part of the financial system brings enormous privileges, but with them, great responsibilities. And I think that's important. It is an important message, I think, for everyone to keep in mind. It's also important to think about how the central bank's perspective on this. Remember, they're not starting new companies. They're thinking from the holistic view of the financial system. And they see participation in the financial system as a privilege and a great responsibility. There is a more succinct version of this quote, by the way. Thank you very much. Okay.